Hey everybody, it's Dr. Joe here for this Wealth Wednesday. Hope everyone's doing fine, doing well, and getting kind of cold here in the DC area. But it's all good. It's all good. We've got another great session lined up today. We're going to talk about some clever ways to come up with a down payment for your next purchase, and that's going to be the focus today. And the reason why I want to do that is that, and I'll give you some backdrop. The main backdrop is that I had a meeting today with a lender, a good buddy of mine. We've done some deals together. He's been lending money, and one thing I realize, is that there's going to be some great opportunities to buy as the market kind of slows down. There are fewer buyers, especially buyers who are looking to buy houses that need a lot of work. And having gone through 4 downturns, and I thought that maybe it's a good time to kind of get ready and position myself to purchase some homes and to take advantage of the opportunities that's going to come through. So I met with a lender today. We kind of talked about different strategies, different options, and so we kind of put together a little game plan, and hopefully that will, provide some opportunities. And so while I was going through that, I'm thinking that for other people who get it, they're probably going to say yes. Although it's a tough market right now, if you're looking to buy and if you have the financing together, there could be some. It's like a window of opportunity that will open up, and if you're able to sort of position yourself, you can go through that window before the window closes. And we don't know when the window is going to close. It could be 6 months from now, a year from now, 3 years, whatever it is. And so the key, though, is to have the financing. And with financing, as we all know, there are 2 components. Component number 1 is the money that the bank will, or the institution or the lender will borrow you, and the rest is the delta, which is on your head. And for a lot of people, that delta is going to be in the form of a down payment. And so the issue is where they're going to get the money for the down payment in order to get the loans to take advantage of some of these opportunities. So I thought it'd be appropriate to have a session where I kind of go through, sort of clever ways to come up with a down payment for your next purchase, whether it be your primary residence, whether it be a rental property, whether it be your first property, or whether it be your nth property. But there's still the same issue, which is where's the money going to come from for the down payment in order to bridge the gap between what the lender will borrow you and what you need to come up with. So again, that's the focus of today. It is, my friends, this clever ways to come up with a down payment for your next purchase. And that's what we're going to talk about today. So as I said before, based on past experience, the market definitely has slowed down over the last few months. Today compared to 6 months ago, 4 months ago, it's almost like a night and day. If you recall, a few months ago, it was like every house that was available, there'd be multiple bids, bidding wars, contingencies, escalation clauses, all that stuff was in. Not so much nowadays. And so therefore, it's still the same point. Where is the money going to come from in order to be able to purchase these houses? So how much money do you actually need in order to participate? That's the first question. And, I'm probably going to answer it in a way that you probably know. I'm not an attorney, but the answer is it depends. It depends specifically on the type of financing that you're going to get. So certain types of financing requires more down payment than others. So how much you need will depend on the type of financing you're going to get and the lender that you're going to go through. Okay. And, but it can vary anyway from on the low end. If you do like FHA and some of the Fannie Mae programs, it could be as low as 3 or 5%. And if you do more conventional, it could be up to 20%, in some cases 25%. So depending on the type of financing that you're going to be doing, or the type of program that you're going to be participating, will determine the amount that you actually need for the down payment. So that's the thing. So as I said before, there are different types of lending. There's the conventional mortgages, which is sort of the traditional lending that typically most homeowners, most investors tend to get. That requires like 20% down. So if you're trying to borrow 100,000, the lender will give you 80,000, and you're responsible for the other 20,000, the other 20%. Okay. So obviously, with conventional mortgages, there are, typically they require what we call full documentation. You got to come up with all the paperwork. There's a lot more hoops you have to go through, and it's more challenging, but it's the rates are usually lower, and but there are a lot more rules and strict hurdles that you have to go through. Okay, and so on. So that's sort of the conventional type, and then we have what we call portfolio loans. And in the portfolio loans, this is typically, it could be in different forms. It could be hard money. It could be what we call what do you call those things? Sort of, these are lenders. Some of these banks, commercial banks, where they keep the loan in house. They don't actually sell it to the third market, secondary market, like they do in Fannie Mae programs, and so on. So as a result of that, there's a bit more flexibility in terms of of their requirements. So they may reduce the requirements from, instead of 20%, 25%, it could be less than that. It could be 10%. And if for some hard money lenders, they'll borrow 100% of the renovations and 90% of the acquisition. So these are loans which are sort of packaged and kept in house. These are more portfolio loans. The good thing about portfolio loans is that they can get the job done a lot faster. It could be anywhere from 5 days, 10 days, 14 days, 15 days, and things like that. So it's a lot faster because most of the conditions and the requirements are in-house. And then you also got what's it called, cash reserves. So obviously you're going to need the cash. Where's the cash going to come from? And that's what we're going to kind of talk about in a bit more detail now, is all that sort of associated with ways to come up with a down payment, this 5, 10, 15, 20, 25% that you're on the hook for. And so it can be a lot of money, especially if you're in expensive markets like we are in the Washington, D.C. area, where you're paying like $300,000, $400,000, $500,000, $600,000, $700,000 for houses. So 20% of of that kind of money, it gets kind of expensive. And so therefore the question becomes, how do we come up with this money? Okay, you're going to tell me, Dr. Joe, I don't have much money. So what can I do? And we're going to address some of these creative ways and during the session today. Okay, so we know we have to come up with, if you're in the DC area, $20,000, $50,000, $100,000, $200,000 for your down payment. And the question becomes, where's this money going to come from? And that's what we're going to talk about that here. But the big thing, though, is I'm a firm believer that the best way to raise your money is to save. Okay, it's to live what's the right word? Live within your means. Don't go too crazy on buying consumer items, fancy this, fancy that. Just live below your means, keep a low profile, and save money. It's just save money. These are the best way to raise money, is to save it. Okay. And if you need to increase your income, then get a side hustle. If you need to raise money, then do that. If you need to cut your expenses, then do that. But it's easier to raise the money yourself than have to rely on other people. So that's the first thing I want to say, is that by far the best strategy is to live within your means, save money. Okay. You can't have all these fancy things. And if you need to do side hustles to get extra income, maybe you can leverage your skills. You may have some entrepreneurial activities that you can tap into in order to raise your revenue stream as well. So that's number one, ways to come up with money. In my opinion, the best way is to save. Okay, it comes from yourself. Now, assuming that that may not be enough, you need to come up with other ways. Let's kind of go through some of those wins. So the first thing I want to talk about is equity. okay, if you have a home, one good way to be able to raise money for your down payment is to tap into that equity. Okay, so if you have a primary residence, if you're a homeowner, especially if you own the house for a number of years, maybe 5 years or so, there's a pretty good chance, since we've had a large run up in real estate in the last, especially the last 2-3 years, there's a pretty good chance you have some equity in your home. Okay, so the question becomes, maybe a good strategy is to tap into that equity, leverage that equity such that you can use that as a down payment in order to acquire more property. And that's what I did. But anyway, so the idea is to get what we call a HELOC. And most of you obviously know what a HELOC is, home equity line of credit. So you go to a local institution, it could be a bank, it could be a credit union, or whatever it is, and you ask to get a loan based on the equity that's within your property. Now, if it's your primary residence, you're able to borrow more than if it's an investment property. And I'll talk about the investment ones shortly. But the idea is that you go to an institution and try to tap into that equity in order to get some financing. So typically the way HELOCs work is that it's almost like a line of credit, okay, which is what it is. And so they'll extend X number of dollars available to you. If you use it, then you're going to pay interest based on what it is that you're using. If you don't use it, you don't pay any interest. A lot of the banks, the home equity lines are free, i.e., there's no annual fees. Whereas some other commercial banks, they may be a fee associated with how much they offer you. I was talking to the lender today. They have these programs like guidance lines, which is another form of lines of credit, which I'll talk about in a second. But anyway, so the idea is that you tap into the equity. Typically, the payments are interest only for a number of years. It could be 10, 15 years. And then after that, you have to pay it back. So there's usually a draw up and then a drawdown. A drawdown is when you have to now start paying back whatever it is the balance is. Okay, so as I said, I've used that strategy before. When I first started, I bought a house. As time went by, the house increased in value. I was able to get lines of credit based on the increase in value, and then I used that in order to buy more properties. So one asset then allows me to buy more assets. So you're leveraging the power of real estate to an nth degree. So that's a very good way if you already own an existing primary residence. Okay, and so it is your primary residence. So if you don't pay, technically, you could lose your house. So you don't want to do some crazy stuff. And most of the time, HELOCs are reported to the credit bureaus. So it may affect your debt to income ratio. And if you don't pay on time, it could affect your credit. Okay. So that is what we call a home equity line of credit. That's a good way in order to raise money for a down payment. Okay. So that's number one. Number two, which is somewhat similar, is the I'm just going to call it rental equity lines of credit. Rental equity line of credit. This is primarily for properties that are investment properties. Okay, long-term buy and holds. So as I said before, I've done the HELOCs where it's my primary residence, but I've also been able to tap into equity from my investment property. Now, investment property lines of credit, they're similar, obviously, but it's slightly different in the sense that the interest rates typically are slightly higher, and also the amount that you can borrow, the loan to value that the lender will give you, is going to be slightly less. So if it's a primary residence, I think they can go like some of them 80% or even 85, 90% if it's for a HELOC. But for a rental property, it's usually a lower equity line. So a loan to value, I'm sorry. So it could be 50, 55, 60, 65% LTV. That's how much you can borrow. So let me an example. So let's just say that you have a house that is free and clear. Let's keep it simple. and therefore, if it's your primary residence, and the bank says we can borrow you up to 80% loan to value, it means that they'll give you a HELOC value of 80,000. Now, if it's a rental property, an investment property, and they say we can only give you up to a 60% loan to value, which means that they'll borrow you up to 60,000. So as you can see, if it's a primary residence, you can borrow more than if it's a rental property. Okay. But again, if you've got rental properties, there are institutions out there that will borrow against that. The interest rates may be a little higher, the loan to values may be a little lower. But again, you got equity that you can tap into to use as your down payment. Okay. But obviously, if it's an investment property, you want to make sure that you do the analysis and that the property still cash flows. When you if you were to draw down that equity line of credit, there may be a few more hoops you have to go through for a rental line of credit versus a homeowner a HELOC, but that's just the way it is. But anyway, the bottom line is that you've got some equity in an existing rental property, and you could tap into that in order to raise money to buy for your down payment. So that's number two. Another one, which is a little creative, is what we call cross-collateralization. Cross-collateralization. Now, what in the world does cross-collateralization mean, Dr. Joe? Okay. And what it is, it's almost like what we call, I don't know if you've heard the term blanket mortgage, a blanket mortgage. So, for example, and I did that, if I recall, about 3 or 4 years ago, there was a deal that I did in Washington, D.C., where I put it under contract, and I forgot the story, the backdrop, but the bottom line is that the seller wanted us to close in 5 days. I think it was 3 days. But let's just say 5 days. That's how much time. And he said that if you don't close in 5 days, I'm canceling the contract. And so we had 5 days to come up with the money. And obviously traditional lenders aren't going to be able to raise $500,000 in 5 days. It just takes too long. Typically they want 2 weeks or 30 days to close. So I had 5 days to come up with $400K. So I went to this lender, and I said to the lender, look, I need to borrow $500K in 5 days. And they say, well, yeah, we can do that. However, the time it's going to take for us to do all the due diligence and so on, it's probably going to be more than 5 days. However, if you got a property, which I did have, which was free and clear, they did what we call cross-collateralization, which means that they said that, okay, we'll borrow you the money, the $500K to acquire this house. But we know that there's equity in the house that you're buying. But if there's not enough time or not enough equity, then I'm going to use my other property, the one that's free and clear, as collateral. So I'm cross-collateralization. So normally it's the asset that you're buying is what you use as a security. So what I'm doing in this case was to use two assets, the assets that I'm buying, plus also the asset which I own free and clear. So if I didn't pay, they now have two properties which they can go after. And as a result of that, they said, yeah, we'll do the deal, and without all the hoops that I typically would go through. So I'm collateralizing, the deal on two properties. I'm cross-collateralizing. And so on. So hopefully that is a little complicated, but hopefully you get me. So the idea is that if you've got some properties that have a lot of equity or free and clear, you can use those assets as sort of a security, as to borrow money. So you can use one asset or several assets to get the down payment money that's needed to purchase some homes. Okay, so it's cross-collateralization. A bit more advanced. Not all lenders will do that, but I had this lender that was open to that idea, and that's what we did to get the deal done. So obviously you now got two properties at risk. So if you don't pay, technically you could lose the house that you're buying, but also you put a lien on the other house that you already have. So the lender's happy because now they've got more security, but you are at a higher risk if you don't do the right thing and pay. But it does allow you to speed and get money and be able to use assets that you already own to get the down payment money that you need to buy more assets. Hopefully that's not too complicated, but that's another way whereby you can raise money for a down payment. The next one, which is number 4, hopefully this is good. I'll kind of do a quick summary in a second. So what we have so far, in fact, I'll probably do a quick summary right now. So the bottom line is this: we need money, down payment, in order to buy some houses. So the question becomes, where's this money going to come from? And so far, I've talked about 4. I've talked about the equity, home equity line. I've talked about a rental line of credit. That's if it's a rental property. I've also talked about cross-collateralization. And number 4 is your 401k. So yes, you do. Well, hopefully you may have a 401k, which is a retirement fund, and you may or may not know that you can tap into that 401k in order to take a loan against it. Okay, it's tricky. You're kind of borrowing money against your own money, really. But there are some strings attached to borrowing from your 401k. If you are 100% sure that you're going to, and I'm not a CPA, so I could be wrong here, but my understanding is that if you borrow money and return it within 60 days, then it's not considered a withdrawal. So you may be able to get around some of these penalties and taxes that are due if you borrow against a 401k. There are quite steep penalties if you borrow from your 401k. But my understanding is that if you can return that money within 60 days, then you may be able to offset or at least avoid paying some of those penalties and charges and so on. I could not, correct me if I'm wrong, but that's my understanding, and so on. So the question becomes: are you able to return the money in 60 days? The chances are it's probably no. In that case, then what you don't want to do is a withdrawal where you take money out, because the penalties can be pretty hefty. Another creative way is to borrow against your 401k. Okay, so you can take a loan against the money that you already have. So you kind of borrow your loan. You're taking a loan against your own money, really, and therefore, there are rules in terms of how it's paid back and the time duration that it's got to be paid back by. But that's another way to raise money, is to borrow against your 401k as a loan, and then you pay the loan back. As I said before, especially if you're under, I think it's 59 and a half years old, there are certain conditions. If you're above 59 and a half, there are also some conditions, but I think I think you can reduce some of those penalty charges. But there are limits in terms of how much you can borrow from your 401k. Again, don't quote me here, but I'm thinking it's around 50%. But the interest rates are lower. And but that could be another strategy whereby you can borrow against your own money, and then you can use that for the down payment. The other caveat, I think, again, I'm not a 401k expert. Another caveat, I think, is that if you leave the job, if you leave your employer, then you have to pay that money back. So as long as you're with that employer, you're able to borrow against that loan against that money. If you leave the employer, then you have to repay all that money back. Otherwise, there are penalties that it could be a withdrawal fee and things like that. So it's pretty hefty penalties if you were to leave your employer and not pay that money back. But as long as you're with that employer, you can just take a loan against your own money, a 401k. So that's a pretty good way. If you've got money in a retirement account that you could leverage, could borrow against in order to buy some more properties. Okay, so that's a fourth way. And let's talk about a fifth way, this is a very good one, which is to house hack, implement the house hack strategy. I know I've talked about house hacking several times before, and Hey guys, I'm back. Oh boy, I'm sorry about that. I don't know what happened there. My internet went down and it's reconnected again. So apologies. That's what happens with Comcast, I suppose, or Xfinity they call themselves. Anyway, I was going to number 5, which is house hacking, and so what's going on with house? A house hacking is a strategy whereby you live in a house, use it as a primary residence. Because it's your primary residence, the down payment requirements are a lot less. So typically for a primary residence, you may need 5% or 3% or 10% financing. Whereas if it's an investment property, you may need 15, 20, 25%. So it's a good way to build your portfolio, in fact, is to house hack. So you are living in that property and you rented part of that space out, whether it could be separate units within the building or it could be rooms in the house. But the idea is that you're getting homeowner or primary residence financing. So whether the terms are better and the interest rate requirements are lower, and so on. So that's a good strategy if you want to start building your portfolio. And also, it's a good strategy for for building a portfolio because your down payment requirements are a lot less. So instead of having to come up with 20%, you could get away with 5%. So let's say if you're trying to borrow 100,000 with 20% financing, you have to come up with 20K. Whereas if you are doing a house hack strategy, you may only need 5K. So in theory, you should be able to get into that property a lot better, a lot faster, because you need less money in order to borrow. So it can really, really work. And it's really a great way to save money as well, because as we all know, the biggest expense for most people is a housing expense. If we can cut that housing expense down, we can usually, save money, and which we can then use to purchase other properties. I think there are programs, I say from FHA 3%. There are some Fannie Mae programs which are 5% or 10% down, and so on. So that's something you may want to consider is implementing the house hack strategy to build a portfolio because you need less money saved. Hopefully, if you do the house hacking strategy well, you can drive your housing costs significantly. I mean, when I was doing it, I think I was living in a house for free because my other tenants were paying me rent, which covered the mortgage. So I was literally living in a house for free, and I was able to save the money that I ordinarily would be spending on housing. I would save that money and use that to build significant savings, which I then use to purchase more properties. Okay, so that is what's it called? Strategy number 5, which is the house hacking strategy. And we're going to kind of talk about strategy number 6 now, which is this one. No, okay, well, no. Okay, now it's probably a good time where number 5 is if you got some questions. I know you always do that. You're going to ask me some questions. So put your questions in the chat box. I definitely want to go through some of those questions. We always have more questions than we have time for. So please put your question, anything to do with real estate. I got some ideas for those people. And this is the result of my conversation today with the lender. As I said before, having gone through these 4 cycles, okay, up and down 4 times, this is the time to get ready to purchase. There's going to be some good opportunities because that window is going to close. However, just having your financing is not enough. What you want to do is be able to hold on to the asset, during these turbulent times. And for 1 year, 2 years, 3 years, 5 years, whatever it is until the market comes back. But if you can hold on to the asset, then you can maybe cash out in the future. So now is the time to get in, have the strategies in place where you can hold on to the property, okay? And therefore, if you want to, you could exit in a number of years from now. Because what you don't want to do is to buy and then unable to withstand these turbulent waters, and you need to sell before the market comes back. As the analogy I gave today was, you don't want to be the guy standing up when the music stops. Okay, you want to have a seat, which means that you want to be able to hold on to this asset and not have to worry. And that's where the tenancy comes in. So I'm thinking it's putting together for those people who are real serious and see the opportunities that are ahead of us. We could put together, I can help you guys in terms of the financing, connecting with lenders, help with the construction. I've got great contractors, help you with the renting. So there's a whole lot of different things we can probably put together. But I do see that this is going to be a great time. It's great opportunities. And I think that for savvy people like you and I, we can do quite well if we put certain things in place, which is what I want to do. So that could be a little project that we could probably do. Let me know if you're interested, and we can maybe talk about it later on. Okay, so we talked about house hacking, and then number 6 is sort of the owner financing. In order to get the down payment, why not just ask the seller if they can borrow you money? That's what we call owner financing. And they're not just going to give you money. They're going to want some kind of security. They may want to put a second lien on the property, and they're going to have some terms associated with that money. When are you going to pay them back? How much do you pay back? When is the balance due? These are all things that you can negotiate. But if you don't have the monies for the down payment, another way would be to get the money from the seller. And that's what we call owner financing. That's a strategy there. I haven't done too much owner financing in the past because when the market's hot, sellers don't have to do anything. They want cash, and they're not so flexible. However, when the market gets soft, then in order to move their property, to sell their property, they may have to come up with some creative financing ideas. And that's where owner financing. So owner financing could become more popular or more common during the slowdowns as they are in the hot market. Okay, so owner financing is something you may want to consider. And obviously, not all sellers are going to be open to that. Not all sellers understand what that is. But there are some sellers, if you articulate it correctly, it may be okay. And another one is the subject to, where you take over a person's current financing and so on. So I've done a couple of those subject twos, and maybe we can do a session just on creative financing at another time. Let me know if that's interest to you. But it could be something that could become more popular, more common as the market slows down. So that's number 6, owner financing. So owner financing is a way whereby you can raise money for your down payment because you're asking the seller to be providing the financing for you, and then you negotiate the terms associated with that money that you're borrowing from them. Okay. The number 7 is to borrow money from friends and family. Okay. You may have friends, you may have family members, you may have associates who don't mind giving you money, not giving you money, but loaning you money. And sometimes family members they're supportive of what you're trying to do. They want to encourage you, and they may avail some of their monies to you to help you on your journey. So again, that's negotiable. It's between you and the other party as to the terms. Is it a gift? Is it a loan? What's the interest rate? What's the payments like? How long is the duration of this before you pay them back? All these things are negotiable, but you're borrowing money from friends and family if you don't have it. Now, if you have it, you don't need friends and family's money. But if you don't have it, you kind of have to go creative. Unfortunately, I didn't come from a family with any money, so that's not really an option. However, I have private investors. These are people who know me. I've got a person of integrity, and they like what I do, and they've got some money, and so they borrow me money. They loan me money. Okay, so this is also includes private money, and but there are people out there, you'll be surprised, who have money and they're tired of getting 0.01% at the Bank of America or Wells Fargo. They want a better return, and they'll be open to discussing them lending you money. But obviously, they're not going to give you money if they don't trust you that you're going to do the right thing and pay the money back. So you have to build some track record. You got to build some integrity. But there are private funds out there available for you. And typically, it's easier to get in terms of the qualification requirements. It's very rare that private friends, family, associates ask for a credit report. It's very rare that they're going to ask you for a loan application. So the the conditions are a bit more flexible, and it's really up to what you both feel comfortable with. Okay, so so that's owner financing, and the terms can be whatever you agree on. And but typically, there's a period of time whereby you borrow the money, and then there's a time where all the money is due. Okay, what we call a balloon. So there are payments, and then there's a balloon at the end of that payment cycle. So that's owner financing, and then we go to that. Sorry, that's loans from friends and family, and so on. So it's a pretty good way. I'm really using this strategy, in terms of for private money, for some of the things which I do. So let's go to number 8, which is co-investing with friends and family. So here is slightly different than the other one. You're borrowing money from them. You're almost like they are debt financing. So you're returning the money with an agreed interest rate and duration and terms. Okay, they're just providing you debt. In this case, they are essentially partners. They're coming in with equity. So the money that they're borrowing you, it's not in form of debt, it's in the form of equity. So they're taking a percentage interest in the deal. Okay. So in some situations, that's the only way you can do it, is that you say, okay, I'm going to give you X percentage of the profits. So they're now an equity partner in the deal in exchange for the money. So in exchange for their money, they want a piece of the action. And I personally prefer the other one, where private money, where I don't give them a piece of the action. I give them a fixed return on their rate of money. Okay. But again, sometimes you may have no choice but to give a piece of the action to your potential investors. And obviously, again, it's negotiations. Each person will be different in terms of what their requirements are, what you're going to have to give up in order to borrow for them to give you or loan you their money, or to be loaned their money. And so negotiation is a very important one. And the other thing is that most of the times you have to agree on the exit strategy. You got to agree on, when does this thing close out, come to conclusion, whereby they go their way, you go your way, and everybody, the deal, the relationship is over, and per the agreement. So sometimes it's usually easier for fix and flips, because we know at the end of the flip is finished, you've sold a house, then everybody just does the accounting and move on. So depending on the exit strategy that you use, if it's a buy and hold or fix and flip, it may depend or determine who's interested in this transaction. Because the other thing you want to avoid is if one of the investors, the equity partners, says we want to sell, and somebody else says no, we like to keep it. Okay, so you have to make sure that your exit strategies are aligned if you're going to go this route. And number 9, this one, a little, sell some stuff. If you got something of value, sell it. It could be a vehicle, it could be an asset somewhere else. But the idea is that you can sell that asset to raise money in order to use it for your down payment. Okay, it's not really, I know a lot of you guys think, well, I don't have anything of value to sell. You'll be surprised. We have Facebook Marketplace nowadays. We have a lot of other platforms where you can sell stuff, and stuff that you don't use, stuff that is just sitting there, that it could be of value to somebody else, and you could use the sales or proceeds from that towards your down payment. So sell some stuff, I know a lot of people don't feel comfortable doing that, but it's a way to raise money. And it's probably unlikely that you're going to sell enough stuff to raise all the down payment, but it's a start. It helps you to raise some down payment money, and so on. Okay, and then finally, number 10 is I saved this for last. This is going to be controversial, but some people have do this. Is credit cards and business lines of credit. If you want to pull some cash, if you really need it fast, then maybe you have no choice but to go with credit cards. Obviously, I'm not a proponent of credit cards for this kind of thing, but I just threw it out there because it is a potential source of money. Obviously, we all know the downside with, first of all, the plus side of credit cards is that the money is available instantaneously. You've already been approved, so you just go spend it. And, the big downside, obviously, is expensive. And the interest rates are high. The points are high. The interest rates could be anywhere from 16, 20, 24% range. So it's not cheap money. And there may be some points, especially if you, do a cash advance, then there's some hefty points on top of that as well. So but in terms of the business lines of credit, I know there are certain programs out there, certain people that sell these business lines of credit programs whereby you can get lines of credit. Some of them are 0% for a number of months. And, they could borrow you 100,000, 200,000, I've heard, at an introductory rate of 0%. So that could be another way to raise money is the business lines of credit. And if you got an entity, there are certain providers out there that will help you get financing using that entity. And that's what we call the BLOC, or the business lines of credit. And, again, I'm not a proponent of, especially the credit cards, because, I try to have a zero balance on my credit cards because those finance charges can be pretty hefty after a while. And so just use that very sparingly. And if you have to do that at all, but definitely look into the business lines of credit because there are some programs out there whereby you're paying very low interest rate, like an introductory rate for a few months, and so on. And then finally, let me just kind of wrap it up. Real estate investors, obviously, I've talked about 10 different ways to raise money for your down payment. Okay, some of them are probably straightforward. Some of them are a bit more complicated. And what I don't want you to do is to think that, I don't have the money for the down payment, therefore I can't do anything. Okay, I want to avoid that because, as I said before, I really do believe that it's going to be a window of opportunity for the next few months, especially as we approach the winter months, where there's definitely fewer buyers out there. For those people who are ready, for those people who have their financing in place, and for those people who are able to sort of navigate these turbulent waters that we're in, I think it's going to be great. I intend to acquire more properties. I don't need to buy a lot, but I think that there are some, there will be some good buying opportunities. And if you feel the same way, let me know. And maybe we can put together a little, as I said before, I'm putting together all the different components of this, which will be the financing, the relationships with real estate agents, another deal finders, the contractors, the tenant components, and obviously the relationships with the housing authorities to pull this thing together. So if you're interested in being a part of that, let me know. These are all deals whereby it's your deal. I don't want a piece of your deal. So I want to make sure I say that clear. I just see that there's going to be a great opportunity. And for those people who are ready, who get it, I think this is a good time to, to sort of position ourselves to buy. So, so you do need money. There are different ways to get the money I've talked about today. I think I talked about 10 of them. And so let's kind of quickly recap. There's the home equity. If it's a primary residence, you can get a home equity line of credit, HELOC. If it's a rental property, then you can get lines of credit based on the rental property, rental equity lines of credit. Another way is to cross-collateralize, where you use one asset as sort of a lien, as a security, I suppose, for another asset that you're buying. So you can sort of, if you've got some free and clear properties, especially, you can use the equity in the free and clear properties as additional security, to the lender, and therefore they may borrow you 100%, because they know that if you don't pay, they're going to take the house that you've got the lien on, plus also they're going to go after the other house as well. So use that sparingly. 4 is the 401k. You can tap into your 401k. You can take a loan out on your 401k. You can borrow against your 401k. Obviously, there are penalties associated with that of early withdrawals. It could be pretty hefty, but you can loan against your 401k at a lower interest rate at better terms. And that could be a consideration to raising money for your down payment. But the other thing is that if you leave your company, it's my understanding that that money is now due. So you have to pay it off or pay the loan back. Otherwise, it's considered, or it may be considered, a withdrawal. Okay, so we talked about 401k. Then we talked about the house hack. House hack's number 5. The reason why I put that here is the house hack. You need less money. You may be able to get away with 5%, 10% down compared to 20-25% down for your down payments. So that's a way to come up with a down payment. So you need less money, so you don't need to raise as much. And if you are savvy enough, you may be able to live in that property at significantly reduced housing costs, if not even free. I talked about how I did that. Number 6, we talked about owner financing, where you can ask the seller to borrow you money, loan you money. It could be obviously in the form of a second lien. You're going to have to negotiate the terms, the conditions, the balloon payment, on all those things. But that could be another way to get down payment money, is through owner financing. And then number 7, loans from family and friends. And I threw in there private investors. These are people that know you, trust you, like you, and hopefully they'll be open to borrow you money as opposed to going out and saving the money yourself. You're going to have to negotiate the terms and conditions associated to that money, but it's definitely a doable, viable strategy is to borrow money from your friends and family. The only downside is that you have to make sure that the lender is okay with that, because they may not be too happy about you borrowing money from other people for your down payment. So that's something you may want to cross over with your lenders. Number 8 is co-investing with friends and family. So in this case, it's no longer debt financing, but this is more of a equity financing. So they are getting a piece of the action in addition to for them borrowing you the money. And so therefore, because they're borrowing you the money and they're getting a piece of the action, there's less money that's needed from you. Number 9, sell some stuff. You may have some valuable stuff that you could sell and hopefully raise some money that could be used towards the down payment, because it's very unlikely that you can sell enough stuff to cover the entire down payment that you're buying. But at least it'll allow you to sell some stuff, generate some money, and hopefully use that towards your down payment. And then finally, credit cards and business lines of credit. I'm not a great proponent of this, but if necessary, it is what it is. So that's the 10 different ways. Hopefully that was helpful. And the important thing is that I don't want you to be wallowing in self-pity. Say, I don't have the money for the down payment. I can't buy any houses, Dr. Joe. I don't want to hear it. Okay, if there's a will, there's a way. I've come up with 10 different ways to raise the financing for your down payment. And as I said before, my goal is that I can help you take advantage of some of these opportunities that's coming up in the marketplace. And as we move forward towards a slowing down time. So if you've got any questions, please put the questions in the chat box. We are going to go to Q&A in a second. So again, it's Dr. Joe. If you got some questions for me, what time is it? It's 7:52. So we've got about another 8 minutes left. And let's go to some Q&A. Let's have a look. What do we have here, my friends? Hey, Marlon, how's it going? Hopefully, we're supposed to hook up, Marlon, if my understanding, sometime this week or next week. This is from Choppy Oh, happy day. Oh, happy day. Yes. Hey, what is your experience with long distance real estate and do you recommend it? Uh, yeah, it depends. I personally haven't done long distance. Well, maybe I have. I mean, I own a couple of properties in London. Technically, that's long distance. But in terms of the US, I tend to buy properties closer to where I live, just for personal reasons. But I know there've been a lot of successful people who do long distance real estate investing. So if you find there are better opportunities somewhere else, then hey, it's fine. But I do believe that the important thing, if you're going to be doing deals outside of your area, is to make sure you assemble a great team. You got to have people who are looking out for your interests, especially the real estate agents, the contractors, the property managers, and so on. Because if you don't have a strong team, with those trades and skill sets, it's going to be very difficult because you're not there. If something goes wrong, you're not there to address it. You're relying on other people to help you out. And if they have got your interest in mind, then that's okay. If they don't have your interest in mind, they could be ripping you off and you just won't know. I was listening to a podcast last week where this property manager was skimming money from, he was telling the owners who lived out of state that some of the units were vacant. But he had some side deals with some people who were living there and paying him cash. So, but the owners didn't know because they weren't there. So again, I'm not saying people all do that, but there are some people out there who don't have your best interest at mind. I know David Green from Bigger Pockets has written a book on long distance real estate investing. So you may want to check that one out. I have the book, and so there could be some good ideas there. But yeah, the important thing is to get in. Oh, happy day. And make sure that your first deal, if it's your first deal, is a success because it's so important that it's a success. It gives you the confidence to go out there and do more. Let's have a look. Next question is Dr. Joe. If this is from Johnny H. Have you seen any homes with assumable loans with good rates that folks want to sell? Assumable loans. Yeah, I haven't seen too many assumable loans per se. But there's a strategy called subject to. Subject to is where you take over somebody else's existing loan without calling it due. So and I've done that several times. So it's a strategy called subject to. And typically you tell the seller, hey, I want to buy your house, but I want to keep the existing mortgage in place. I don't want to get a new one. Now there's a bit more risk on the part of the seller because technically the mortgage stays in the seller's name. So if you're not upstanding, if you don't have integrity and you walk away and not pay the mortgage, then it's going to affect the seller's, ultimately the seller's credit report because you skipped out. So I don't suggest you do subject to unless you are 100% committed to doing the right thing and paying the seller's loan, come what may. Okay, they're doing you a favor. You don't want to stick it to them in the back. So that's the other thing I was think. Subject to is a great strategy, but you got to have the right attitude if you want to be successful there. So that's a subject to, which is not technically assumable loans, but it's a way whereby it's seller financing really, where you can take on the existing financing without getting new financing, and so on. Okay, hopefully that was helpful. Next one is from Cars and Crypto. Would you suggest trying local credit unions for HELOCs? Certainly. Some of the local credit unions, their rates are very reasonable. In fact, they're lower than banks, and some of the terms to qualify are more reasonable as well. And on top of that, sometimes they borrow more money than banks. So yes, I would definitely suggest you consider some credit unions. Now, if you have a credit union that you already have an existing relationship with, then you may want to consider approaching them. If not, then you may want to do some research of local credit unions in your area. The other thing about credit unions, though, is that they tend to only borrow in properties within their sort of catchment area. So if you're in Washington, D.C., it's very unlikely a Washington, D.C. area credit union is going to borrow on a deal out in Texas. It's very rare. It's probably impossible. They want to do deals in their service area, like the Washington, D.C. area, for example, and so on. But definitely, what's it called? HELOCs. They some credit unions do offer them, and it's something that you may want to check out as well. Okay, yeah, this is from Cars and Crypto. I'm very interested in learning subject 2. Maybe I could do a session on subject 2 at a future time. Maybe I'll do that, or just on seller financing. Monica says that will be great. I'm interested. This is where I'm thinking. Shoot me an email for those people who are interested. Shoot me an email, joe@joeasamoah.com. As I said, my goal is in the next few months is to put this thing in place whereby we can we can start buying, and you can leverage my relationships with financial institutions, contractors. You can use some of my systems that I have in place. My relationships with the housing authorities in order to get tenants, screen tenants, move tenants in, and so on. So I just think that there's going to be some buying opportunities, especially for those people who are ready and those people who want to do it. Atlanta investors, how is your credit affected throughout you? How is your credit affected throughout you? I'm not sure what that means. Let's have a look. Has credit been an issue with you and these financing? Okay. If you want to go with traditional lenders like the banks, credit unions, some of the commercial institutions where full documentation is required, they will pull a credit report or credit check on you. So a lot of this stuff here, the assumption is that you are taking care of your credit. Okay, you're not skipping out on people, and you are taking your financial obligations seriously. I protect my credit, protect it. I pay if there's a loan on. I pay all my loans. If I have to not eat, then so be it. I want to pay my financial obligations. It's really, really important that you maintain your credit. If you have sort of tarnished it, then that's okay. It is what it is. You can start building on that. You can go through some credit repairs, or you may have to go with a partner. But the important thing is to, credit is important. I'm not saying it's the be all and end all. For hard money lenders, it's not as important as, say, a bank. For private, if you're borrowing private money, they don't usually pull credit reports on you. So there's still strategies whereby if you got average credit scores, you can still get the financing. It's important, but it's not a showstopper, in other words. Oh, happy day. I actually have that book. I'm actively reading it as of now. I'm not sure which book you're referring to. Maybe it's the David Green's one on long distance real estate investing. Okay, Jim Junior Minerink. Hello, sir. Thanks for your time. What has been your experience being with purchasing properties subject to? I said I've done several of those. The important thing is make sure that you do the right thing and pay the lenders or pay the mortgage off every month, regardless. Make sure that you have a clear agreement with the seller that you're taking over their financing. Most sellers don't understand this, so it's going to require some education on your part. So you're going to be able to explain this and be able to address any concerns and fears that the seller may have. So you have to know what you're doing in order to be able to explain to other people. Sometimes you have to have an extra insurance policy because you don't want to cancel the existing policy, because that's going to trigger the mortgage company and possibly impact on what they call a due on sale clause. Okay. How do you structure your portfolio? You got some good questions here. Oh my goodness, it's 8 o'clock already. Okay, so I think we're running out of time. I'll do this one. How do you structure your portfolios of loans, and how do you structure your typical acquisitions? How do I structure my portfolio loans? I have a number of loans, obviously, and I have relationships with various financial institutions, primarily residential and commercial lenders. I typically it's a two-part financing strategy, and on the acquisition, I'll go to a lender and typically borrow 70, 75, 80% on the acquisition and the renovations. We'll do the renovations, and ultimately, once the house is fixed up, then we'll do a refinance and replace what I call the short-term financing with permanent financing. That's how I do my stuff. So I have different lenders that understand what I'm doing, appreciative of what I'm doing, and they will then fund those transactions. And the parts which are the delta between the what the bank will borrow me and what I need, that could be in the form of private investors and also in terms of personal money. So that's how I structure my typical acquisitions. Good question. I think we are done now. It's 8:04. A little bit over than I thought it would be. But again, we always get these so many questions. There's quite a few questions I haven't been able to answer. So you may have to, what's it called? Come back next week. And again, my email address. This is for let's have a look. Who wants my email address? This okay, this one. Okay, oh happy day. My email address is joe@joeasamoah. joe@joeasamoah. Let's see if I can put that down. And that way you can shoot me a email and let me know if you were interested. And I will definitely. So I really do want. I want to do this. Let's see, joe@joeasamoah.com. There you go. How about that? Okay, joe@joeasamoah. That's my email address. So shoot me an email. And if you're interested in, sort of connecting with me and I want to go through putting some strategies together to acquire properties during this during this downturn. I really do believe it's going to be a lot of opportunities, and I'm trying to put the pieces together: the financing, the relationships with real estate agents to fill the pipeline, and the contractors to actually do the work, and then helping you keep the asset for 3, 4, 5 years until the market returns, and then exit in that time. That's where I see the opportunities. And if you are that way inclined, just shoot me an email and let's talk and see what I can do to help you out. I'm really interested in people who are serious because these are serious times. And I really am not interested in tire kickers and people who kind of just, this is some serious stuff. And now is the time, if you're serious, to make it happen. Okay, my friends, it is now 8:06. And I'll wrap it up for the day. I hope that today was good. Hope you enjoyed something. I hope you learned something. And I'll see you next Wednesday at 7 p.m. Eastern time. Take care. Have a good one. Bye for now.